Hello, I want to say it says Chimeri. That's your email address though, so I'm not quite sure if that's your first name. But welcome. Thanks for being here. Appreciate you being early. And we'll hang out for just a second. We'll start just after 7. But thanks for coming. I hope you can hear me. Let me know if you can. Hi, Gabby. Welcome. If you would just let me know in the chat if you can hear me okay. I don't want to be like obnoxiously loud or be too quiet. Welcome, Irene. Chimeri. Did I say, how do I say your name? Is it Chimeri? Thank you for telling me you can hear me. Very appreciative. Thank you. Amazing stuff. Amazing. Let's see. Well, I want to tell you guys, thanks for being on time. I'm going to respect you and your time since you're here at the top of the hour. I'm going to go ahead and get started. And I am so excited to share with you just how to avoid these 6 most common mistakes that I see new home buyers make. And obviously you have some interest in getting into a home, and that's why you're here. So I'm excited to share and show you some of these things to help you avoid some of the pitfalls that I see as people are going through the process. Now, as a first-time home buyer, if you would, I would love your input into the chat on this screen. But as a first-time home buyer, do you feel any of these words, adjectives, I believe they are, concerned, stressed out? Maybe you feel a bit intimidated or anxious. Are you any of those? Maybe uncertain. And if you would, please key into the chat which of those words would be the closest representative to your feelings right now about buying a home. Because I'm excited to help you overcome any or all of those. So please, if you would, enter in what you are. We'd love to have interaction. It's so much better if I can talk back and forth and kind of respond with you on the chat based on what you say. So as a first-time homebuyer, do you feel concerned, stressed out, intimidated, anxious, uncertain, or maybe any or all of them? Sometimes I had somebody say all of them. So I asked that person, is that a picture of you right there? Anyway, well, what I want you to know is don't worry, because you have come to the right place. Because we're here right now to get you from where you stand, however you feel, anxious, frustrated, whatever, to there, where we're handing you some keys, uncertain, okay? So hopefully my hope is that you will feel a lot less uncertain by the time we're done talking. Because I want to take you from where you sit now, uncertain, and get to the point where we're handing you the keys to your home. So that to me really gets me going. So imagine, if you would, what it would be like if you could have a dog. Okay, a lot of renters I talk to are frustrated because they can't find a place where they can have their dog or have the pets they want. Imagine what it'd be like if you could drive a nail in the place where you live and hang a picture, instead of having to do those 3M things that don't poke holes. What would it be like if you maybe had another bathroom that your family needs? Maybe your family has a log jam when you're trying to get ready to go somewhere all around that one bathroom, and it's just not enough. It causes a lot of contention and frustration and angst in your family. What would it be like if you could paint your kitchen cabinets or paint over wallpaper or choose a color that you like? What if you could have a nice yard? Some people want a yard for their pets. Some people want a yard for children. Some people just want a place to go out and dig in the dirt, get their hands in there and plant something, because it's cathartic and it's amazing and it's helpful. But you know, what if you felt like making friends with your neighbors because you knew you'd put down roots and you were going to be there for a while, instead of like, a lot of times when you're renting, you don't really bother to branch out because you know it's a short period of time anyway, and you're just not staying. So imagine what it would be like if you could do any of those things, maybe all those things, whichever seems most applicable to you. Well, that's where we're headed. We want you to be able to put down those roots. And so I want you to just to tell you, just stick around to the end if you can. And if you can't, by the way, I'm going to go ahead and just post a link right here if you have to duck out early before we're done and you still want to have a free home buyer readiness consultation with me, I'd love to do that. So there's a link in the chat if you want to book one. I'd love to do that if you have to go before we get to the end, and then I pass that out. So just so you have it, but stick around to the end because I've got an ethical bribe for you. And we want you to have this ethical bribe, and it's truly worth $1,550. And we'll talk about that later and how it looks, but it's worth it to hang around. And I promise I won't be boring. And we want you to have that bonus, so hang around. Hey, real quick, you're not here to learn about me, really. But let me tell you a little bit about who I am. I'm doing the talking. My name is Gary Munson. I'm a father of three. I have three girls. They're 26, 21, and 16, almost 17. So they're older, and I'm a girl dad, and I'm a proud girl dad. But on the other side, at work, I'm a financial guy. I think is the easiest way to describe it. I do have a broad understanding of markets. How long is the meeting? Should go about an hour. Depends on how long, question and answer goes, but it should be around an hour. I have a BS in accounting in college. I obviously have a mortgage license, but in my past, I've had a real estate license. I've also had a securities license and an insurance license. In fact, I still have the insurance license, but I've been in mortgage world for 20 years. And why that matters to you is I've seen over 1,000 loans get to closing. And what you need to know is I've seen a lot of pitfalls and a lot of potholes in the road. And I know how to steer, you around those that I've already seen. It doesn't mean that I know everything. We can avoid every challenge because every loan is different. But I want you to know that I've seen a lot and have a good understanding of how it all fits together. So I'm here to be your financial guide and to make it easier. Let me introduce my real estate partner that helps me with these meetings. Tonight, he can't join us because he's actually out showing a home with a family that was on the webinar just last Thursday. So sometimes this can get going pretty fast if you're ready. But if you're not, it's okay. We're here to go the pace that you are. But Steve is one of my great friends. I know probably 100 realtors in Utah, and he's the one that I do my transactions with. He's where I sell my house. He's the one that I use when I go buy them. And one of the reasons is he is a property value expert. He has an amazing understanding of how values work and correlate with the financial markets and how things are going. And so he knows how to read what the real estate market's going to do. He's been a realtor for over 20 years. So we've both been around for a long time. I want you to feel really confident in the expertise that we have. But one of Steve's real keys is he's a great negotiator. And so as we find a property that you want, he's going to negotiate the best deal possible for you. And that's one of the things that he's so good at, is getting you in when you want it, kind of getting closing costs negotiated, getting our best price, our best deal. He's amazing at that. And so I'm grateful to partner with him on these first-time homebuyer seminars. I'm sorry you won't hear from him tonight because he is out making it happen for one of our attendees last week. But he'll help you contract for your success. Now, as we get started, everyone's always wondering, hey, who pays who? Where does the money go? So as far as who pays the real estate agent, don't worry about it. Steve gets paid by the seller of the home that you buy. So that's already taken care of. You don't have to worry about paying him. And I am a mortgage broker. And I'll talk about what a broker is. I'm not attached to any one bank. Which means that I go and I work with, 25 or 30 banks. And my job is to find the very best loan that fits each home buyer. And the nice thing about it is when I bring them the loan, they will pay me for bringing it in. So that means you don't have to pay me. So the only charge that will come to you in this transaction from our company, Trillion Mortgage, will be your credit report. And we won't charge that until we close, and that's $80. So our stuff is covered, both the agent and the lender's piece. So that's awesome. Now I want to start just with a little bit of controversy. I want to get your attention. Now, I found this headline on entrepreneur.com by a guy I greatly respect, Grant Cardone. He is really an amazing sales trainer, and I have a ton of respect for him, but I really didn't respect what he said here. He said, buying a house is for suckers. He says a home is not an investment because it does not pay you every month. So to him, an investment is something that returns every single month. And so he says, should you own a home? Unless you have 20 million in the bank in cash, you have no business buying a house. Well, I think he's crazy. And I'm going to show you why. And by the way, the reason he says that is he likes renters. His goal is to own 20,000 doors. So he mostly buys big apartment complexes, and he wants people renting. And that's one of his drivers. He wants these big rental doors. But let me show you just an example that can happen with what it's like to own a home and why I believe that it is an investment. So let's say that you purchased a home that was $400,000. And let's say that we found you a 1% down program. I've got a couple of those. So you brought into the transaction $4,000. So that's nice. Now let's say you held on to it for about 3 years and the market appreciated around 6% per year. Now, over the long haul, that's probably pretty average. Over the last couple of years, that's low. but let's just say that it appreciated that amount and you were able to sell it at $450 in 3 years. So obviously there's $50,000 worth of profit there. Now, that's a 12.5 times your money, or a 230% return each year. Now, I don't know where you go to find a 230% return that can run for 3 years in a row. I don't know where it is, and it's certainly not safe if you find it, I don't think. And the nice thing about it is if you live in that house for 2 out of the last 3 years, you don't pay taxes on that $50,000 of profit. There's no capital gains due. So it's awesome. You also got to take advantage of some yearly tax deductions on the mortgage interest. But I don't know where you go to get that kind of rate of return anywhere, honestly, especially in something that's as safe and steady as a brick and mortar home. It's something that's real, it's tangible. I love that. Well, let's talk a little bit about that home equity, because the census 2016 found out that the majority of Americans' net worth actually comes from their home equity. How much? 63% of net worth of Americans comes from the equity in their homes. And so if you never own a home, you're going to be missing 63% of your potential net worth if you're an average American. So I want to help you get on the buying and owning side, and I'll show you how to do it. And let me just do one other comparison about renting versus buying. The nice thing about buying a home is you actually lock down the housing portion of your budget. Maybe some of you have experienced this raising the rents that we've seen. It's been going crazy for about the last year and a half. Every person I talked to was like, yeah, they just barely raised my rents. Has anyone had their rent increased in the last year or so? I'd love to know, because the numbers are wild, up 80% since 2019 in the pandemic. And as home values go up, landlords are like, yeah, we're going to charge more on rent. And a lot of the people that we're talking to, I talk to day to day, are feeling it. And so has it increased for you, though? You don't care about the people I talked to yesterday. What matters is, did it happen for you? And did it increase? So if it has, I mean, I believe it will, when will it stop? Well, so let's talk a little bit in comparison about a mortgage payment. A mortgage payment on 30 years is fixed. The principal and interest part will never change. The amount is the same. The only thing that will have potential to move up or down is taxes and the homeowner's insurance. Now, property taxes are probably going to go up. Homeowner's insurance is probably going to go up, but that is a small portion of your overall payment. And so the vast majority of your housing is going to be locked down and steady. The nice thing too is if you're an owner, you can finally benefit from inflation. Now, inflation is something where we've printed too many dollars in the economy, and there's extra dollars chasing the same old stuff. So that means that the prices will increase because people have more money to pay. And so what happens for you is, if you lock down a 30-year fixed home mortgage and maybe your payment today will be $2,500, your $2,500 in 10 years won't hurt nearly as much, won't sting as much as that $2,500 hurts today, because you'll be paying that $2,500 with dollars that are shrinking in purchasing power every year. And so in 25 years, you're going to be like, $2,500, who cares? What will rents be then? I don't know, $7,500, who knows? But the nice thing is you're locked down and you're paying for that with shrinking dollars. And so you can benefit from inflation. I hope that makes sense. Now, by the way, we are going to have a question and answer at the end of the presentation tonight. Please, if there's something that you're wondering about, and if I don't happen to cover it, please write it down. I'll stay on and we'll talk for as long as you guys have questions. I'd love to help you understand everything that we've talked about and answer any and all questions that you have. So please write them down and then we'll talk in a bit. Okay, well, I mentioned a minute ago about tax advantages that you get from owning a home. Now, I'm not qualified to give you specific tax advice. I don't stay current with it, but check with the person who does your taxes. And this is what you need to ask. Are you itemizing? If you're itemizing, then you definitely will benefit from using a tax deduction from your mortgage interest that you're paying. If you are itemizing, no, if you are not, if you're taking the standard deduction, then it won't help as much. But I will say this, I know Trump's tax plan increased the standard deduction. I understand Biden's have shrunk it. So how does adding the interest that you might pay to the equation change things for you? Now, in a current 24% tax bracket, by the way, it only takes a couple of jobs making maybe $20 an hour to get to a 24% tax bracket. So let's say you're in a 24% tax bracket, and let's say that you paid $22,000 in mortgage interest. Maybe that $2,500 a month payment would generate that kind of mortgage interest. Your tax burden could reduce by $5,340. What does that mean to you at the end of the day? Well, April 15th, instead of breaking even and not getting any money back from the IRS, they're sending you a check for $5,340 because you went from being a renter to an owner and you got to write off your payment that was going to interest. So it's a pretty big deal. It moves the meter. What could you do with that extra $5,300? You could pay down a mortgage. You could pay off some other debt. You might go buy something else or heck, go on a great vacation. But that's up to you. But one thing I do know is that rent has no tax advantages. And it's going to probably continue to go up. So where we first start is looking at credit scores. And so what determines the number? Because the credit score is important. We're trying to hit probably a 580 credit score to get a low down payment home loan. So what determines the number? Now, they assume the best in you when you begin. I've seen people starting at 800 with very little credit history at all. Now, if you have a 740 or above, the interest rates stay the same. They don't improve when you go above 740. They're like 740, same as 760. But 620 is kind of a baseline for best programs in mortgage lending. As I already mentioned, we can go 580 with 3.5% down. And I talked to a lot of people who think they have really bad credit and they're a 580 and we can get them in for 3.5% down. So there is absolutely hope for a great deal, a lot of people. Now, how do they do this? How do they determine what the score is? They use an algorithm, which is a formula that kind of takes into account 35% of the formula goes to payment history. Now, they don't care if you're 18 days late. They care if you go more than 30 days late. So don't go 30. 29 is fine. Don't go 30 days late. The other thing that really moves the meter and the thing that makes a big difference for us that we can adjust quickly is amounts owed. How much, if you have a credit card with $1,000 limit, how much of that limit are you utilizing? If you're at if you're at $850 on $1,000, that's going to hurt your score. And then types of credit you use. And this I don't like. I think this is discriminatory. But if someone has fancy credit like at Nordstrom or Dillard's versus maybe if you've heard of Sears or maybe TJ Maxx, it hurts your score a little bit based on where your credit is. New credit comes into play as well. Is if you've gone out and opened a whole bunch of new credit cards or gotten a brand new car loan, maybe it hurts you a little bit because they're not sure why you're opening up new credit. Maybe they feel like you've gotten laid off at work, or maybe there's something on the horizon for you. And so they kind of think that comes into play as not a good thing. So there are 3 credit bureaus, and they use the middle score of all 3 for everybody who's on the loan. So we pull 3, we take your middle score, and that's your score. If you're on with someone else, we compare the 2 middle scores, and the lowest one, that's the score that we use for interest rates. So that's the way that the credit scoring piece works. So we have ways to manipulate credit scores. If your score is a little bit lower than you want it to be right now, we have ways to adjust that. As I mentioned, one of the things we can do is adjust balances. And I like that the credit scoring is very top of mind for so many people. Most everyone I talk to knows what their score is, at least per like a Credit Karma number or something they see maybe on their bank statement. And that's kind of a generic credit score. So a Credit Karma score, or that generic Equifax that shows up on your bank statement, is just a general algorithm or general formula. Automobiles have a little bit different formula, and so that score will come out differently. And mortgage lending has a little bit different formula. It will adjust based on things that they feel are more important. Maybe how has your payment history been on the long term, things like cars versus just a credit card. And so they adjust it a little. There'll be algorithm differences. But one of the things we can do is when we pull credit, we have a way that we can go in and do this thing called a what if simulator. So maybe the middle score was 631. And we wanted to get it up to 677. So it goes in and it tells us, it's like, hey, pay down this card to this balance. And it's usually trying to get the balances under 60%. And so again, on that $1,000 credit card, if we can pay it down to $600 or $595 right before the credit card company reports to credit, then your score is going to improve. If you go over 60%, your score will drop, and it can be 30 points. And I have a lot of people who are like, why on earth? I was a 740 last week and now I'm a 710. And sometimes it's just because balances went up and the balance got reported. So that's one of the things we can do. Try to bring it down under 60%. And that's a really easy way. And then if it's, a little more intensive than that, we can look at what if scenarios. And if it goes beyond, we have basically 3 or 4 really good scenarios. And if it's more than that, if we're, low 500s, maybe we need to get you to a credit cleanup expert, but we'll send you there. So we can go to work on credit for you. Have no fears. Don't let that knock you out. Now, I wanted to give you an extra 5 or 6 points in the next 3 days, because when we do pull credit for you, we do a hard inquiry, which means it's an actual credit pull of your history. Now, that costs you 5 or 6 points from your credit score. So if we're going to take that sometime in the future, I would like to give it to you. I'd like to give it to you up front, so it replaces that for you. And so write this down: optoutprescreen.com. It's right here, optoutprescreen.com. This is what it'll look like when you get to the landing page. This is managed by Equifax, Experian, and TransUnion, by the 3 bureaus. And what this is this lets you go in and say, look, I have no interest in unsolicited credit cards, and I have no interest in unsolicited insurance offers. And so you go in and say, I don't want it for 5 years. You put in your name, your email address, your birthday, and your social. And then you say opt out. And what the bureau says, man, what a conscientious credit user. We're going to go ahead and give them 5 or 6 points. And it's worked for 20 years. So hopefully you can do that. Go get 5 or 6 points. You might as well, because at some point in time, you're going to have to pull credit, and it'll cost you 5 or 6 points. Well, let's talk a little bit before we go to the next. We're going to get to a mistake here in just a second. But let's talk a little bit about the differentiation between a down payment and cash to close, because there's sometimes some confusion between these two phrases. So a down payment is a percentage of the purchase price that actually reduces risk for the lender. Let's go back to that $400,000 house I talked about at the beginning of the webinar that we bought and I held for 3 years. Now, I put down 1% on that loan. So a 1% down doesn't really make the lenders comfortable. They would love it to be 20% or more. And the reason is say, for instance, there was a downturn in the market, a temporary downturn, and that house went from being worth $400,000 to $350,000. It drops to $350,000. The bank's going to be like, what if Gary loses his job? And so I get laid off from my job. I can't make my payment. The lender's going to be patient with me because they can't sell the house and get the money back that they're owed. And it's a little risky for them. So if I put down the 20%, then suddenly I only owe $320,000, and the market of that house is $350,000. then they're protected. And so the down payment part goes to reduce the risk for the lender. Usually the best scenarios, the best rates in first-time home buyers come on a 3% down or 3.5% down. And so the down payment portion goes to reduce risk for the lender. And then there's something called prepaids. Now, prepaids is a sum of money that is used for your benefit in the early part of your loan before you make your first payment. The lenders expect you to buy a year's worth of homeowners insurance up front because that home is the collateral for a big sum of money to the bank. And if a tree falls down on your house when you're driving home from closing, they want to make sure that it's covered and will be replaced and repaired. And so they make you buy a year's worth of homeowners insurance right up front. And then you have to pay daily interest until the end of the month that we close in. So we usually try to close towards the end of the month if we can. And that reduces your cash to close. And the reason is mortgage interest is paid in arrears, which means you use it for a month before you make a payment. So say that you closed on July 31st. You would skip August. You wouldn't have a payment due until September. That payment due in September is paying for the use of the money during July. So instead of, if you would have closed earlier, instead of closing on July 31st, maybe you closed on July 20th, you'd have to pay the lender 11 days of interest to make it square for them. So prepaids is money that goes towards you in the early part of the loan. And then closing costs, which is a common phrase in our industry. This is money that we pay to people for doing work on our loan. So we've got an appraiser who goes out and gives us an independent valuation of the home. The lender requires that, and you want to know too. You don't want to overpay for the home. The other thing that it goes to pay for, the highest part of closing costs, is title insurance. And title insurance is ensuring that you are the rightful owner of the home and the person who's selling you the home has the right to sell it to you. And they want to make sure that, there's not any judgments or liens. And so it's all yours. And so the home ownership becomes clear for you. And then lender costs. So appraisal is usually about $600. Title work it varies based on the loan size, but it's usually $1,500, $1,600, maybe up to $2,000. And then the lender cost is usually about $1,000. So hard costs or closing costs are usually about $4,000. Now, have no fear, in this kind of market, we usually have the seller pay for your closing costs. We can usually have the seller pay for your prepaids as well. So that leaves you with coming up with the down payment. And we've got some ways to reduce that as well. And we'll talk about that in just a minute. Okay, first mistake, thinking that you need 20% down. This is so common. We try hard to tell people we've got 1% down programs, 3% down programs, but still people think, oh my gosh, I've got to come up with 20%. And if that were the case, no one would own a home until they were 50, because it's hard to come up with that money. And as I mentioned, we have these exclusive programs that we can get for as little as 1% down. But let's talk about why that 20% thing lives in our society. And that's because banks want you to have 20% down. As I mentioned about that story about putting 1% down on the $400,000 home, banks would be so much more confident if I had 20% of my own blood, sweat, and tears in the home. In fact, if, for instance, they had to take that home from me and sell it, it's going to cost them about 20% of the value of the home to get me out, to fix up the house, to pay back interest rates and legal fees, and then sell it in a hurry. They're not going to put it on the market and wait for a year for a great offer. They just hurry and sell it. So they just want their money back. And generally, that's what they get, is about 80% of what the home is worth. And so that's why they want that 20% down thing. It protects them against default. And so the great thing about it, and there's a lot of people giving mortgage insurance a black eye, and I love mortgage insurance. And the reason is this lets us buy homes with less than 20% down. Because what happens here is a mortgage insurance company comes in and says to the lender, hey, if Gary goes bad on this loan and he loses the house, we'll pay the difference. Whatever you don't get back from the process, we'll make you whole. We'll pay the difference for you. And so it protects the lender. And so it's always there whenever your down payment or is less than 20%. Now, if you put down, say, 3% or 5%, that's the highest cost of mortgage insurance because there's more risk to the mortgage insurance company. If you put down a little more, you go below 5%, maybe down to 10% down, a little bit lower, somewhere between 10 and 15% down, still lower. And maybe you put down 17%, it's just a little bit above 20%. That's the lowest cost. And the nice thing about mortgage insurance is the prices on this have reduced. FHA just reduced theirs about 7 months ago. Conventional lending has reduced theirs. Mortgage insurance is not what it was 5-6 years ago when it got kind of a bad black eye. And some of these kinds of mortgage insurance can be removed if we can prove to the bank that you only owe 80% of what the house is worth. So it's not so bad. You have to, in that scenario about getting rid of it, you have to keep it. You have to make your payment for at least 2 years before they'll remove your mortgage insurance, but it can come off. Okay, so first time home buyer down payment options. That's why you're here. You want to find out what's out there. There are some no money down loans. Now, this is the down payment part. We still have closing costs. We still have prepaids, but the money down part we can take care of. There's a program called USDA, United States Department of Agriculture, and these are loans that are meant to help populate kind of sparse rural areas. And if you wanted to get a USDA loan zeroed down, you have to go to a USDA approved area. So closest to Salt Lake, I think, is Eagle Mountain, which is just on the other side of Utah Lake, on the west side of Utah Lake. Or if you want to go west of Provo in Santa Quin or Payson, there's some USDA territory there. Or if you want to go north, North Ogden and above has USDA territory. So if you want to be in kind of those areas, we can get you in for zero down payment, which is really nice. Hey, if you're a veteran, you get access to the very best loan on the planet, which is a VA loan, or Veterans Administration. And if you served, thank you for your service. You deserve the very best loan. It's amazing. No mortgage insurance, no money down. It's a great one. And we've got some programs where we use an FHA loan for the first, which is a 96.5%, so 3.5% down. And then someone comes in and does a second mortgage for 3.5% down. And that's okay. If you can't get in any other way, that'll do it. It'll reduce your purchasing power just a little bit, or at the same purchase price, your payment will go up probably $100, $120 a month if you go zero down. So there is some value in coming up with some down payment if you can. Okay, the next lowest down is a 3% down. This is a conventional loan, and there's some real power in a conventional loan. And we'll talk about the difference between a conventional loan and an FHA loan here in just a minute. But FHA was the original, it was the OG of low down payment loans. It was the first time anyone had anything like a 3.5% down, was the Federal Housing Administration. It's a great government loan. And let's talk about it. As I already mentioned, 580 on the credit score, you can go 3.5% down, which is amazing. And again, most of those down payment assistance programs or grant programs that we can find, maybe community-based, or those 80, the first and second combos, are based on FHA. It's an FHA loan. And so the FHA is really, really nice. Now, the downside to an FHA loan is the mortgage insurance never goes away. You can't have it removed, even if you can prove that you only owe 80%. One of the reasons they do that is it has a built-in interest rate reduction feature, which is amazing. If rates happen to drop, maybe 2%, and you want to just reduce your payment, but maybe you can't get your home to appraise, or you happen to be out of work at that minute, we can do a new loan for you without proving a job, and we don't get an appraisal. They'll just lower the payment, and it's a really nice guarantee to have. But we pay for that by having mortgage insurance that never goes away. So sometimes it makes sense to buy with FHA, and then as values increase and we can prove that you've already got 20% of equity, we refinance and put you on a conventional loan and get rid of that mortgage insurance. But when you do, you lose the option to do that streamlined interest rate reduction piece. It's a nice loan, and it's more flexible on a borrower. Sometimes I have people that have a bankruptcy in their past, and FHA is more flexible, 2 years since a Chapter 7 discharge. On a conventional loan, it's 4 years. And so it lets us get into homes quicker after we've stubbed our toe. So it's really flexible on the borrower. It's more strict on the property. The appraisers have to go in and check for things like chipped paint or cracked glass on a window, or they got to make sure if there's more than 3 steps, there's got to be a hand railing. They care about safety. And so it's a little harder on the properties. And so when you go in with an FHA offer, the seller's like, oh man, I'm going to get nitpicked here a little bit. I may have to, fix these little things. And sometimes they do, but it's okay. An FHA is a great loan. Comparing to a conventional loan. Conventional loan are the rates that you see quoted on the freeway, on the radio, on the internet, the low rates that you see. Usually you need a 620 credit score to get a conventional loan. But as I mentioned, the nice thing about it is if we do a low money down, that mortgage interest can be removed. Again, you have to make payments for 2 years, but then if you can prove to the lender that you've picked up 20% of equity, they'll take away your mortgage insurance. Now, conventional is way more flexible on home condition. They don't care if the shingles are bad on the roof. They don't care if there's a broken window. They don't care about stairs or chipped paint. But they are stricter on a borrower. As I mentioned, they don't let you have as much debt. They don't let you qualify to borrow as much money. And they're tougher on you if you've got some stub toes in your credit past. But hey, we'll pick the right program for you. Just know that there's a couple of options out there. We tend to go with conventional in a tight market because it helps to get our offers approved, because the sellers are, if they're looking at an FHA offer and a conventional offer and it's the same price, they'll be like, I'm going to get nitpicked. I have to fix the paint and the windows if I take FHA. So sometimes it's easier to do conventional to get the offers approved. But hey, it's a great program. And they've come up with a 3% down program to try and compete with FHA. And it's great because it just gives us more options for our first-time home buyers. It's great, great stuff. Okay, mistake number 2, and this might be the worst one. Oh, forbidden love. Guys, don't fall in love with the home you cannot afford. Oh, and it makes my heart hurt, because maybe you're just out there and you get the wild hair. You're like, I want to buy a house, and I'm looking at Zillow and I'm looking at this house and it's 800,000, and man, look at the master suite on that. Are you kidding me? That the swimming pool and the family room and the kitchen. Wow. And then you're like, I could only get qualified for 500,000, and homes at 500,000 look a whole lot different. And when you're looking at your homes in your price range, if you fell in love with that other one, man, you're suffering by comparison. You're sad, you're heartbroken. So don't do it. So how do you know what price range that you should be shopping for? And I'm going to tell you, don't skip steps. Get your numbers. I'm going to give you 2 numbers. If we can spend 15 minutes together, I'll tell you how much the lender will allow you to have for a payment. And then I'll do some math and figure out what purchase price correlates to that payment. So I'll be like, hey, look, if you can stand this payment at $2,500, that's going to mean you're in $475 to $525. And then you'll be looking in the range where you want to be, and you don't fall in love with a home that you can't have. So I'm going to get you your payment, and I'm going to get you your price, and then go shopping. We always do it backwards because nobody cares about the numbers. They care about having a home and then, a dishwasher and a yard and that extra bathroom, those things we talked about. That's more important. So, hey, let's get you your numbers before you fall in love with the wrong thing. Okay, back to the content. What makes up your payment? So sometimes you'll hear people in our industry talk about something called PITI. And we'll add an A here in a minute as well. But PI is principal and interest. This is mortgage repayment back to the lender. So this is repaying them. Usually it's over 30 years. Repays the loan, P and I. Then there's T, which is property taxes. And the lender puts that into the equation because obviously you got to pay that too. And we do 1/12 of the taxes most often is paid every month. And they hold it in an account called an escrow account, where they just collect 1/12 at a time until November. And then they write a check. Because I promise you, in November, no one wants to write a check for $3,000 for property taxes, because you've got everything else coming up in November, Christmas or whatever. And so we do 1/12 of it, so it's there ready and taken care of for you. So annual property taxes, those are due in November, and we want to have that handled. And then homeowners insurance, we got to make sure the lender will force you to have that covered. They want their collateral protected. And as I mentioned, you have to pay for a year right up front. And then as part of your payment, we collect 1/12 again. So after 1 year, they have the money to go buy the insurance again, and it's paid for in advance. So you make sure that your home is protected. You make sure the lender's collateral is protected. And then there's mortgage insurance, which is part of it if you have mortgage insurance. And then that plus A would be association dues. Sometimes if you're looking at a condo or a townhouse or what's called a planned unit development, there is a homeowners association, and those have dues. And if it's a condo, sometimes a homeowners association due is like $350, which feels like a lot. Sometimes on a townhouse, it's less, but this is usually to go pay for things like garbage collection or, keeping up the grounds. Like if you're in a condo complex, somebody's got to plow the snow, somebody's going to take care of the flowers, somebody's going to mow the grass, somebody's going to keep up the, the clubhouse and the pool. That's where it goes. Now they make sometimes on a planned unit development, that's where a builder came in, and normally you could have maybe 8 houses in there, and they decide to jam 12 townhomes. And the city comes in and goes, I can't take my snow plow in there. I can't even turn it around. So it's up to you to clear your own snow. Our garbage trucks can't get in there. You got to pay for your own garbage. And so homeowners association pays for that stuff. So just know if you're a condo, a townhouse, you're going to potentially have an association dues, and that gets added into your total payment. So how do we qualify? Let's look at the numbers and figure out how much payment they're going to let you have. So it's my job to make sure we pick you the right loan, and it's my job to make sure that I'm using income that the lenders allow. So we have some what's called debt to income ratios. It's debt divided by your income. So total monthly debt. It's not things like homeowners insurance. I mean, it's not things like your car insurance or your utilities. They don't care about that. They care about monthly payments like credit cards, student loans, car payments, and then maybe your PITI as well. So we figure out what your payments are. I divide it by your usable income, and on a conventional loan, they will not go above 49.99%. So if you make $5,000 a month, we can only have $2,500 going towards debt. So say you had a $500 car payment. So if I could use $2,500 in debt, $500 goes to the car, that leaves me $2,000 for your housing. If we go to FHA, as I mentioned, FHA is a little more flexible. They'll allow you to take a higher percentage of your income towards debt. And so sometimes we use FHA because it allows you to qualify for a little more home. So it can go to almost 57. Now, sometimes the number the bank says you can do is above your comfort level. So sometimes they'll say, well, what would you be comfortable paying? And they're like $2,200, and the bank says they would give them $3,000. It's up to you to kind of land where you want to be. So sometimes we want to talk about potential changes that are coming in the near term. Like, is somebody going to leave the workforce? Is someone going to go back to school? Is someone going to maybe have a baby? Or they just hate their job, they're going to do a new one and they're going to work less on that one. And so we want to make sure we're accommodating you. We don't want to stick you with a payment that's going to be like a big weight around your neck. We want to make sure that we set you something that's going to let you succeed as you go forward. Now, right now, we use a loan program called a buy down on an interest rate. And right now, we're seeing a lot of what they call a 2-1 buy down. So right now, I quoted today somebody like 6.99% on a conventional loan. So let's just say that's 7. Now, on a 2-1 buy down, what we do is we have the seller pay some money to buy down your interest rate. So in the first year, it goes at 5%. The second year, it goes to 6%. And then the rest of the time, it's at 7%. And the idea is it's just kind of a temporary fix while we're waiting for interest rates to come back down. Because most people believe that in the election cycle, they're going to come back down. Most people believe that we'll have them down even by the end of the year. So that allows us to get you in at a lower payment in the beginning. So we may want to talk about a 2-1 buy down. We have the seller pay for it, and it's a nice way to get going. So let's talk about logistics of getting the loan. What am I going to ask you for? I'm only going to ask you for what the lenders need, but they like to see 2 of everything. So I got to see 2 years of income history. If you're a W-2 person, an employee, I want to see your W-2s. If you're self-employed, I want to see 2 years of your tax returns. And then they want to see your 2 most recent pay stubs, and then 2 months of bank statements. So where lending sometimes gets tricky is proving where your cash to close is coming from. And if you remember, we talked about cash to close, what's down payment plus your prepaids plus the closing cost. So whatever you're bringing in, they want to make sure it was yours. Or if it wasn't yours, we have a gift or we have a source for it. And some of this is because of the Patriot Act. Back when 9/11 happened, a lot of, believe it or not, terrorism was financed through mortgage lending. It's crazy. They come in and buy a house with dirty money. They'd go do a refinance and get cash out. And then suddenly they had their money that was clean. And so we have to answer some questions about deposits. And so we look back 2 months, so 60 days, and anytime there's a deposit bigger than what your normal payroll would be, then they ask for where did it come from. And if it's a loan, if it's a gift, we can talk about it. I need to know where you've worked for 2 years, and sometimes it's a school plus work. If you're just recently coming out of school, it's no problem. We just need to know where you've been, and then 2 years of where you've lived. So that's what we're looking for. They'll also want a picture of the front of your driver's license because we need to know who's getting the loans. Again, back to the Patriot Act. And then if you have a cosigner, like a relative that's going to help you, we need all those same things from them as well. Okay, mistake number 3. You guys are holding on well. Ignoring down payment incentives. Guys, there's bags of money sitting around, and don't ignore them. Go get them. And I'm going to help you do that. There are grant programs that is free money, and these are often incentives for helping improve neighborhoods. There's, for instance, something called the officer next door or a teacher next door. Now, people believe that if you had a policeman that bought a home in a neighborhood and he parked his police car on the street, that will affect crime in the area. That'll reduce crime. There are people who believe that if a teacher lives in the boundaries of the school, it will improve the neighborhood. It will help the teacher relate. And so you'll start to see that there's reasons why they'll give incentives to these kinds of people. Sometimes it's just a city that wants you to live in their place for 3 years. Okay, so Ogden has an awesome grant program. Own in Ogden. They want you to live there for 3 years. They'll give you like 10 grand up front. Now, there's some strings attached to it. If you sell your house within 3 years, they want the money back. But if you live in it for 3 years or more, you're good to go. Now, they have boundaries on it. It's got to be in Ogden if you want Ogden money. But there's some places, there's some things we can help you find. Okay, some of these programs end up making you owe more than the house is worth. Something called Utah Housing, which I try to not use. We've also got a 1 to 1.5% down payment grant that we can talk about that's exclusive to our company that'll help you get there faster. So instead of having to save clear to 3.5%, maybe you save to 2%. Or instead of saving to 3%, maybe you just save to 2%. We use the grant to get you in there. And I have a lender that will give up to $4,000 right now as well for people who are in the right income. So, and that can be used anywhere by anyone. So we've got some really cool programs. Let's talk for a few minutes about you to see if we can qualify. That'd be great stuff. Okay, mistake number 4. Oh, guys, choosing the wrong lender type. Bank, broker, or banker. And friends do not let friends use banks or bankers. Why would you use the bank? Because it's logical. You feel like that's where the money is. So you're going to go in there and you'd be like, hey, can I get a home mortgage? I've got my checking account here and my savings account. Oh man, you guys, the bank, Chase, Wells Fargo, any of those guys, it's slower. Their fees are higher. Their rates are higher. With their underwriters, man, if they mess up or you mess up, you give them the wrong paper, one shot and you're out. They just don't care. But the reason they're slower, because they just don't care. Their fees and rates are higher because they have to pay for all those branches everywhere. And they got to pay all those middle managers, all those salaries. Crazy. But it's logical. You'd think to go there. Well, don't let your friends do that. Okay, there's someone called a banker. Now, they act like they're a bank, but it's not Chase and it's not Wells Fargo. I'm not going to say what it's called, but it might be Citywide or Intercap. These guys are much like a bank other than they sell the loan at the end of the month. They close it in their name and then they sell it. But what you've got is the same problem. Higher fees, higher interest rates because they've got branches all up and down the Wasatch Front, because I guess they feel like you need to walk in and sit down with them. And one shot and they're out. Or you can use a mortgage broker. I already mentioned that that's what I am. Mortgage brokers have lower fees and lower rates because we can go hand pick the lender that fits you. And that's my job. So maybe there's 30 lenders we have access to, but there's probably 3 or 4 that really like the kind of buyer that you are. And so I'll go find that lender that has an appetite for you. Then we'll send them there and you'll get the easiest way through. They'll give you a lower rate. They'll have lower closing costs. In fact, don't just believe me. Over here, there's this, there was this survey that was done by AIME, and they did a comparison of people who used banks and bankers versus mortgage brokers. All across the country, 2021, if you used a broker who uses a wholesale loan, it saved $9,407. Less for using a broker. That's a lot of money. And if you're a minority, it costs you another $1,000. It's not fair. Why do banks do that? I don't know. It makes me throw up. Just don't let a friend use a bank or a banker. Find a mortgage broker. They pay me. It's cheaper. It's more efficient. We have one office. It's just off of 53rd South and I-15. We'd love to meet with you if you want to. But honestly, a lot of the people don't even care if they meet me. I meet them at closing the first time because they're happy to transact over the phone. And we don't need to have offices all up and down the Wasatch Front. So anyway, okay, mistake number 5. They're coming hot and heavy now. Mistake number 5 is skipping the home inspection. Oh, guys, don't do it. Even brand new homes aren't perfect. It's hard to believe, but man, builders, if you've ever built a home, they are in a hurry to get done and they are waiting on the guy in front of them. So the cabinet guy is waiting on the drywall guy and the carpet guy is waiting on the cabinet guy, and somebody's got a delay and they hurry and they cut corners to get done. And even Steve, who's been doing real estate for 20 years, isn't trained in all the potential issues. Code changes constantly. He doesn't know what's going on behind that electrical panel. He can see that it's old. He can see that the shingles are probably worn out, but he doesn't know how much more time the shingles have on them. So what we do is we engage an expert, a home inspector who's paid to climb up on the roof, crawl in the attic and look at how much insulation there is. They turn on the showers. They make sure that they go up and down. They run the disposal. They run the dishwasher. I mean, they give you an idea of what's going on. So the idea is when you're paying this much money for a property you're going to be in for a long time, you're going in with your eyes wide open and you know what you're getting. And so we're going to suggest that you do not skip the home inspection. Now, these are about $400, and I think it's $400 well spent because, man, I would hate to have you miss something. You know, maybe it's a meth house. Maybe it's, you know, maybe there's a whole bunch of mold behind that swamp cooler. I don't know, but we want you to know. And these inspectors are paid to find those things. And then he can take that inspection and Steve will go back to the seller and go, yeah, we were going to give you this much, but man, it's going to cost us this much to fix it. So you can either fix it or cut some off of our price. And so they can negotiate down. So it's good for you. It's good to know what's going on. It's good for the price. So that is an important thing. Don't skip the home inspection if at all possible. Okay, almost done. I wanted to give you a real quick 10,000 foot overview about the mortgage lending process, and that's way too small to understand, so I'm going to cut it in 2. First thing we do, guys, is we meet and we do a pre-qualification application. It's a consultant. We consult to find out if you've got the credit score you need. If not, we put you on the road to get it. We look at your job history and your income. We see how much you've got. Do you need to make more money? How much would you qualify for today? Let's get you your 2 numbers. Then we pull credit and we run that through automated underwriting approval, which is a step right here. Almost every loan right now is done based on a computer's approval. And so when we get the approval, I write a pre-approval letter that's really strong that says, hey, trust this home buyer, the money is handled. So you can accept their offer with great confidence. When I give you the letter, you go shopping with Steve and find the home you need. It's at this point in time, really about the time we give you the pre-approval letter, we start giving you an email of the different listings in the areas around the valley where you want to live. You know, it's this number of bedrooms, this many baths, I need a garage, I want a yard. You tell Steve the parameters and he sets you up on an email. You'll get a listing email of every home that comes on the market that fits your parameters. And that's how we get to see what's out there. So we get you that letter and you're out shopping. Now, for me, I gather the income and assets, the two of everything I was talking about. I get the copy of your driver's license and I send this over to the lender. And the underwriter goes through the stuff to make sure I remembered all the rules, to make sure that this pre-approval is for real. They'll come out with what's called the loan estimate, which is the first look at what your cash to close is going to be. It's not perfect, but it's our best estimate at the time. And you sign a document that says you intend to proceed with the loan. At that point in time, they let us work on it. We order the appraisal. And up here, you'll see there's a bit of a delay. It takes about 5 days for an appraisal to get back. So while that's going, we get the underwriter looking at your full assets and credit and your income. And we also order the title report. That usually takes about 3 days. That, again, verifies who's the owner, who has the rights to sell, to see if there's any tax liens or anything. And then we go out and find you a homeowner's insurance quote. We usually check with your auto insurance carrier. And then I have some that are really inexpensive as well. And we'll check with them too. And it goes into underwriting for final approval at that point in time. Hopefully it comes out and you're good to go. Usually it asks for another pay stub or maybe another bank statement, or they want me to explain what happened on a deposit. No problem. And they let us sign something called the closing disclosure. The closing disclosure requires 3 days wait. Once you sign it, we can't sign final papers for 3 days. So we want to get that done and the clock running as soon as we can. So the clock goes as soon as 3 days have passed. The lender prints the loan documents. We go to a title company and we do a lot of signing. After you sign, then you wire your cash to close to title and the loan records, hopefully the same day. And at that point in time, the agent hands you your keys, which is the picture that we started with, and you can move in. And that's kind of our process. Now, let me give you a quick warning. Well, there are 10 commandments when buying. Now, what you need to understand is while we're building your file, we're carefully painting the picture of you as an amazing credit risk that the lender will have no worries lending money to you. And so we want to be careful as we're doing that as we go through underwriting. And so there's these 10 things we want to avoid. So the first one is thou shalt not change jobs, become self-employed, or quit your job. I had a buyer who quit after she signed her closing disclosure. The last thing the lender does before they send the money is they call to verify that you're still working. And that loan blew up right then. So it cost her appraisal, cost her earnest money. She had to go get a job and start over, and we got her into a home, but man, it was a lot of headache for her. So don't change jobs, hold on. And I think she was going to get fired, and that's why she quit. But the lenders look at these indicators. They have credit monitoring. And so number 2, thou shalt not buy a car, truck, or van unless, or you may be living in it. So, hey, if your engine in your car blows up and you've got to have a car, call me and, find a payment that's similar. You're okay. If you've got room in your debt to income ratio to increase it, fine, call me. Let's talk about it, but let's be eyes wide open. Number 3, thou shalt not use charge cards excessively or let your accounts fall behind. Don't go 30 days late. Don't increase the balances. Number 4, thou shalt not spend money you've set aside for closing. As I mentioned, we're looking at it in your account for 60 days. And if a bunch of it goes out and we can't track where and it comes back, it becomes a bit of a headache. You'll be frustrated with me about how we have to document that. So let's talk about it. If you need to use money, let me know and we'll talk about it. Number 5, thou shalt not omit debts on your application. So just, if you have a debt and it's on your credit report, let's talk about it. Number 6, this is a big one. Thou shalt not buy furniture. So a lot of times it comes to the closing disclosure. We're waiting 3 more days before we can close. And you want to schedule RC Willie to deliver your fridge because you want the fridge when you move in, because a lot of these houses don't have a fridge. So they go over to RC Willie and they open up an account and they buy a fridge, and their debt to income ratio was right at the top. And then the credit monitoring shows that RC Willie pulled their credit. They make you write a letter. What happened? Well, we went to RC Willie. Did you buy anything? Yes. They adjust your debt to income ratio. That could kill you. That could kill your loan. So let's be careful about it. Don't buy furniture until it's done, until it's recorded. Then you do whatever you want. But until it's recorded, they're monitoring. And thou shalt not have any inquiries on your credit. This is what I talked about. Thou shalt not make large deposits without first checking with your loan officer. Thou shalt not change bank accounts. It doesn't kill you, but it just complicates it. And number 10, thou shalt not co-sign on a loan for anyone. Because if you co-sign, they expect that's your responsibility. And so all of that's going to be in play if it happens. All right, mistake number 6, and we're almost done. So if you have any questions, start keying them in to the chat. Last mistake, missing out on an exclusive DVP incentive, which is discover, evaluate, and protect. This is that $1,550 I was talking to you about from the very beginning of the webinar. We want to protect you. We've got you. If you work with Steve and I, we will pay for your property appraisal. That's $600. We will pay for your home inspection because we want you to have one. We want you to be eyes wide open. That's $400. We will make sure that you have a home warranty. That's $500 or $600. So that is $1,550 of money that would come out of your account. Instead, it's going to come out of ours. We're going to cover it for you. But it's conditional on you booking a discovery call. Maybe you're not going to buy for a year, and that's okay. Let's talk about it. Let's make sure your score is in line. Let's make sure your job and income is in line. Let's make sure that you're in a good place to buy whenever it's going to happen. But in order for us to cover you with the DVP, you have to book a discovery call. I put in the chat the link to set that free consultation. And so just go ahead and book and we'll talk about it. I'm self-employed. Can you buy a house or look for a job? Irene, we'll look at your tax returns and see how much you're paying taxes on. They'll give you the income on what you're paying taxes on. And sometimes on a tax return, we can give you back things that you've written off. So we want to book an appointment. Let's look at your tax returns and see how much income they'll give you. And then you must hold the appointment. Now, if you have to reschedule once, whatever, but we want to make sure you hold, and then we'll give you that, that $1,550 worth of value. And then, of course, we want to close your business, and then we'll take care of you. So go ahead and book. I put the link in there. I'd love to spend a few minutes with you talking about you and your scenario, help you chart your path to where you want to go. Okay, question and answer time. I hope you've got a few. I'm going to read one or two that come up often while you're keying those in. So here's one I see quite often. Will old unpaid collections make it so I don't get approved? It's a good question. Collections used to be harder, but with automated underwriting, that's gotten more flexible. FHA doesn't really care. We hardly ever ask for those to be paid off. What it does do is drag down your credit score a little bit. So sometimes it makes sense to pay them off. Sometimes it makes sense to leave it alone. So we'll look at it and figure it out. Let's see. I bought a home with my spouse, but want to buy my own now. Can I be considered a first-time home buyer? Okay, so by definition, a first-time home buyer is someone who hasn't been on title to a home in the last 36 months. So if you haven't owned a home, been on title as an owner in the last 3 years, you're a first-time home buyer. And there's some really nice incentives for first-time home buyers. They get lower cost mortgage insurance and they get better interest rates because they're a first-timer. The lenders are giving us kind of a break right now. So it's nice to be able to get that if you can. Let's see. What's better, to own a condo or a house? I'd usually give this one to Steve, but I'll tell you, it kind of depends on you and what you're doing. So there's a lot of people that in their life cycle right now, a condo is appealing because they don't have to worry about doing yard work or shoveling snow or putting up Christmas lights or any of that stuff. They can go out and live on the weekends when they're not working. They can go do their thing. And then there's other people that don't want to have a shared wall. A condo has a shared wall. People that want to have their own space, have their own yard, have a place for their dog. So it's up to you. What's better? It kind of depends on where you are in your life cycle. Okay, let's see. How can I contact you when I'm ready to buy a house? Yeah, it's a good question. In fact, let me go ahead and I'm going to just forward to the next screen because the next screen has my phone number on it. So we definitely want to make sure. Sorry, here's my phone number, Irene. I'd love to talk with you about you and what you're working on. let's see. So why not you? I think I lost my list of questions. Okay, so okay, does earnest money count towards down payment? And do I get it back? Yes, earnest money is included in your cash to close total. So sometimes earnest money, they generally want a couple of $3,000 to make sure you're serious when you make an offer. And that money is counted in your down payment cash to close total. So that's a good one. Can you get it back? And hopefully if you back out of the house within the contracted dates that say you can, then you'll get your earnest money back. So we can do that. Let's see, is it cheaper to buy an existing home or to get one built? That's a good question. It just depends, honestly. Usually if you can build a home, you can build in some equity. Usually you build in about 20%, but it feels like a lot of purchases, right now there's a lot of new builds. So sometimes that's great. There's pros and cons to it. You know, it's pros and cons to, if people want shade and trees and lower traffic, you'll buy in an existing neighborhood. If you want a brand new house and you're okay with no shade and, you know, more traffic because they build more and more houses behind you, you know, it's going to change. It's up to you. There's some good things there. Sometimes it's less expensive to buy an older one and you can fix it up. It just, you know, depends on the place. And that's sometimes a realtor's question. Let's see, does the home need to be fairly new to qualify for FHA? That's a good question. Not really. Sometimes homes were built in 1920 have been remodeled, you know, top to bottom. They pulled it out and did all the new plumbing and new electrical. It's all great. You know, and I've seen 6-year-old houses with chipped paint and, you know, broken windows. And so it just, you know, the age of the home doesn't always determine that. Let's see. What if you put down 5%, but you have breaks in your employment? Okay, so we want 2 years of employment. So perhaps it's, we're going to look back 2 years, and we'd love to see 2 years, but say, for instance, you had a break of 3 months. It's okay. If you go get a new job, we'll let you get your mortgage with one pay stub. Go get one pay stub. And as long as we've got 2 years in the workforce, you're good to go. If there's a break of more than 6 months between the jobs, you got to be back on the job for 6 months. And then you're good to go. So, so there is that. Let's see. Let me see if we've got any other questions in the chat. I do not. Well, guys, I don't want to drag you out any further, but here's the question. Why not you? Why not you? What are your numbers? Let's figure it out. Let's figure out how much income, you know, how much of a payment the lenders will let you have. Let's plan a strategy. If your score is a little low, I can help you fix it. If your income is shaky, let's figure it out. If you're self-employed, let's look at your numbers and figure out how much, again, the lenders are going to let you have. Let's plan a strategy. If you're not ready to buy in the next couple months, let's get one planned for whenever you're ready. I'm here to work with you at your pace. I'd love to chat with you about that specifically and build a game plan for you. But book a time that matches both our schedules. That's access to my calendar, and I'd love to chat. My number there is 801-560-2999. If you want to just chat, you know, anytime, give me a call. I'd love to help you get into your home. That'd give me a great charge. I'd love to see what you're doing and help you get your keys handed over. Let's see, any other questions? Let's see. Okay, how about this? I'm married. Does my spouse need to be on the loan? And the answer is no. Sometimes it makes sense if maybe one of the spouses isn't working right now or isn't contributing income, or maybe has a bad score. Because as I mentioned, the lenders are going to look at the middle score of both of you and then use the lower score to grade the file. And so maybe one of the spouses has a bad score. If we can do the loan without them, the payment will be lower. And so you do not have to have the spouse on there. And if the spouse wants to be an owner, we can close the loan in your name. And then right after we close, we can add a deed that adds your spouse as an owner. So they could be an owner, but not obligated on the loan. And a lot of times that's preferable. That's the better way to do it. So, so that makes good sense there. Let's see. What's the average of closing costs? Okay, so closing costs is just one of the 3 cash to close matters, but hard cost for closing costs is usually $4,000. And then it's usually $1,500 to $2,000 to cover prepaids. So often we'll ask a seller to pay about $6,000 in closing costs, and that'll cover it for you. Then you just have to do the down payment portion. So talk to me about low down payment options, because I got a lot of them. There's a lot of grants. I've got specific grants that are exclusive to only Trillion Mortgage. And man, don't leave that money sitting around on the table. Let's see. Can I use my 401k for down payment tax free? It's a good question. I know people sometimes will get a loan on their 401k. I think you have to get it back in at a certain point in time. Your 401ks all have what's called a plan document that gives the instructions or the specifics. So you can check with your human resources folks, and they can tell you, if there's a way you can pull that money out or just take a loan. So I would check into that. That sometimes make great sense. I had a buyer about a year ago that she thought it made way more sense to buy the house and make income on the appreciation of the home rather than having it divided out on the stock market in a mutual fund in her 401k. And okay, I didn't stop her. Let's see. I just opened a business credit card. How long do I need to wait before I apply? And you don't have to wait at all. What we'll do is, if you've opened the business card, we just look at minimum payments for credit cards. And then we plug that into debt to income ratios. One thing that might get a little tricky sometimes is student loans. Most people aren't in repayment right now. And so most of the lenders have a rule where we have to take a plug figure based on what you will end up paying on the student loans. FHA requires us to use 1% of the balance. And so maybe you have $50,000 of student loans. So that means we have to plug in $500 as a potential payment. Sometimes there's an income limited payment that you can get. And if we can prove that you're on that income limited payment, then, and it's less than the 1%, we can use that. But there's conventional programs, it's only 0.5%. So that would be 250. So student loans are something we just need to be careful with, make sure we're, taking those into account. Let's see. How long do you need to live in the US before buying a home? Came to the US 4 months ago. Okay, so FHA is flexible. If you have a social security number and a right to work visa in EAD, we can go to work. Now, FHA likes to see 2 years of work history. So if you are an immigrant from another country, we may have to track your work history at your previous country. But we can go to work on that if you have a social. We work on getting you some credit. And that might be a time where we talk to kind of just ascertain, hey, where are you with your credit score? Where are you with your employment history? And make sure that we can, that you're in position to do it as fast as you can. Love to talk to you about that. Okay, guys, I've kept you for a good while. See if there's any questions I have on the average list. Oh, okay. How long is the period you recommend keeping those 10 commandments you mentioned? And I'd say if you are under contract to buy a house, like you've picked one, you've made an offer, it's accepted, then let's start worrying about that. So it's a really good question there. And at what point could I refinance an FHA loan to a conventional to drop mortgage insurance? It's a good question. Mortgage lending isn't meant to be short-term financing. So you have to make at least 6 payments before you do a refinance. And there are times when the market really moves, where values go up really high. And so you could do a refinance out of that after you've made 6 or 7 payments, if it makes sense. Sometimes it does, but usually it takes a little longer than that, but nothing shorter than 6 or 7 payments, and then you can switch it over. As again, like I mentioned, if you wanted to remove that mortgage insurance from a conventional loan, you need to pay on it for at least 2 years, even if you can prove equity before 2 years. So they want you to pay 2 years. All right. If we use you as our mortgage broker, how much are your fees on top of down payment and prepaids and stuff? And as I mentioned early, the lender pays me for bringing them the loan, so it doesn't cost you to use me. You might as well use me because I can get you a better deal, even better than a credit union. A lot of times people think credit unions are the lowest price, and they're not. Most of the time, a credit union will charge you 1% of your loan amount as an origination to get the same interest rate I'm going to give you with no origination. So I can definitely save you money or lower your rate. So love to talk, guys. Thanks for sticking on with me. It was a long time, but I was so glad to have you. We'd love to chat with you personally and and build you a scenario, a game plan to get you into your home. All right. Any last questions? Thanks so much for being here, and enjoy your night. I hope we can talk further and I can get to know you more personally. Take care.